Let's get to that. Breaking news. Canadian inflation in August quickening, accelerating to 1.9% year over year. However, that year over year rate slightly lower than the economist estimates of 2%. Okay, and then consumer month to month, the drop was tiny, 0.1%. The estimate was for the CPI to be unchanged. So month on month, it looks like inflation slower marginally than had been expected. We're joined now by a former Bank of Canada economist and current chief economist at Alberta Central, Charles St-Arnaud. Charles, thank you very much indeed for joining us.
Good morning.
You've had no time to look at these inflation numbers, I know, but we did get a drop in inflation month on month of 0.1%, so just a rounding error. But the core CPI trim hitting 3% year over year, and the core CPI median hitting 3.1% year over year. So inflation still quite a bit above that 2% nominal target.
Yeah, well, and that's where the Bank of Canada's concern has been for some months now. Their preferred measure of core inflation, so both CPI trim and CPI median, has been either at 3% or slightly above 3% for the past, I think, 5 months. So that's a bit of a concern. It's at the upper end of the target. However, what is a bit more will be a bit of a relief for them in the numbers is that the pace of the increase in those prices is a bit more consistent with the inflation target. So when we look at the 3-month annualized price change in core inflation is at about 2.5%. So suggesting that inflation pressure are still in the upper end of the target, but below that 3% level.
From this result here, I mean, are you still expecting the Bank of Canada to cut as the overall probability is tomorrow, 25 basis points?
Well, I think 25 basis points tomorrow is almost a given. We've had, over the past month, a lot of data that is suggesting that the amount of slack in the economy is much bigger than what the Bank of Canada was seeing in the July meeting. So first, we had the GDP that contracted by 1.6%, which was bigger than what they were expecting in their own forecast. We also had another month of weak employment data with a second consecutive month of job losses and continued increase in the unemployment rate. So even though the economy is not what I would say, it's no longer deteriorating. The recent data suggests, for example, manufacturing sales yesterday were suggesting a rebound there. Is that we're not deteriorating, but that doesn't mean that growth is picking up at the end of the year enough to reduce the amount of slack in the economy.
They stuck with a benchmark interest rate of 2.75% for 3 meetings. And I mean, Tiff Macklem could give the market a shock tomorrow, the Bank of Canada governor, if he says, no, I'm standing pat.
It will be a bit of a surprise, more that it will kind of solidify that really the Bank of Canada, the only thing they care right now is about inflation and how sticky it has been so far this year. But at some point, they need to start having a bit more of a forward-looking approach and realizing and seeing that the increased slack in the economy will bring down inflation in the coming months. Already, core inflation in my own forecast is expected to be below 3% by October. So it's just a couple of months away. And it's not like, and like I said, the dynamics suggest that we are seeing the easing that they would like to see.
Of course, there's a long delay, isn't there, lower borrowing costs before they actually transmit to the economy. And what economists, what the government would like to see is Canadian firms borrowing more for productive investment. But why would they right now with this tariff cloud?
Yeah, and that's in some ways, something that they also need to be careful is that lowering the borrowing costs and the hope is that businesses will jump and invest, and that's what we need. Obviously, the high level of uncertainty right now doesn't necessarily make the environment appealing for businesses to invest substantially in their machinery, equipment, and their operations. The concern the Bank of Canada will have is that what if it's spur another wave of big borrowing from the household sides, where we know we already have some vulnerabilities and where we could run into some issues.
It's kind of interesting, isn't it, how Canada is the opposite of China. We have a population that's taken on a lot of debt, but we have underinvestment in infrastructure and business capex.
Yeah, and the issue is that it's not something that is new. We've been in that cycle or structure of the economy for the past 25 years. We've been persistently underinvesting in productive investment or productive means. While at the same time we have our households that have been borrowing or excessively borrowing, and to spend on things that are not necessarily enhancing our productivity. So we'll need at some point to solve that problem if we want actually to have higher productivity growth in the future.
Talking about the whole productivity situation, jumping ahead on that. Yeah, you're right. We've lacked on productivity and has been going down. What's the solution for that? Do you foresee any possible movement as far as policy goes in Canada?
Well, I think we need to start to really understand well, why has productivity been weak and what have been the driver of this weakness? Part of the solution and part of the problem has been persistent underinvestment in productive things over the past 4 or even 5 decades. Canada has been under investing in those to a point where actually just a couple of years ago we were spending almost as a share of GDP on renovation and home ownership transfer cost. Then we were investing on machinery, equipment, and IT. How can we be productive if we invest so much in flipping homes that are not productive? And that's the thing, is that at some point there are evidence that I wrote on that the household borrowing over the past 25 years have crowded out the business sector. Mm-hmm. So we'll need to really think about that. It's more fundamental, it's way more structural than we think, and we need to start thinking about that. It's how we incentivize financial institutions to lend to businesses rather than to households.
Charles, Don Drummond, a distinguished former economist at TD, argued a few days ago that Canada's corporate tax subsidies and regulation favour small businesses, but the problem is large companies are the ones that have higher productivity, export more, and do more research and development. So is it time to tell small companies, sorry, we're going to be supporting big firms more in future?
Well, part of his solution and his observation is right. Those who are businesses that are productive are often bigger corporations because they have the capacity to be leader in their market and to be at the cutting edge of their industry. However, it doesn't solve another problem where when we look at to invest, a business needs to borrow. And unfortunately, our financial system put a lot more advantage to consumer borrowing or household borrowing than on businesses. Whether it's when we look at capital requirement, you need 3 times more capital for the same dollar investment lended to a business than for a household. So it's that structure that will need to be thought, is how do we ensure that the businesses that want to invest can actually get the funding they require.
Just jumping back to what we were talking about with inflation and a little bit of a different topic here. We saw the inflation rate come in on some of the measures a little bit better than expected. Do you see that having an impact on the Canadian dollar versus the US dollar? Very much of an impact at this point?
Yeah, well, I think at this point, it's more of a US dollar story than a Canadian dollar story. I think the economic story in Canada is well known around the world, that we are struggling because of the impact of the tariffs and that the Bank of Canada will need to cut rates. Then it's more the change in narrative in the US, where we're going from a place where just 2 months ago it was hard to expect there was expectation that Fed will cut, but not as quickly and as immediate as now. Now we have market fully pricing in 25 basis points cut in September, and there could be more. Just clear sign that the U.S. is slowing probably faster than what the market's expecting, and that's putting the greenback on the back foot, on top of also of some headwinds from all the politics down south.
Charles, thanks very much indeed. Really appreciate it.
Thank you for having me.
Charles St-Arnaud, former Bank of Canada economist and current chief economist at Alberta Central.